Why do most professional stock pickers struggle to beat a boring index fund after fees? That one question explains why index funds became so popular with everyday investors. This is Money Hacks USA, where we make your money work smarter. An index fund is designed to track a market index instead of trying to guess which single stock will win next. It is simple, diversified, and usually low cost. That does not mean it is risk-free. Index funds can drop when the market drops. But for beginners, they offer a way to invest without needing to read 200 earnings reports or predict next quarter winners. Today, we will explain what they are, how they work, what fees matter, and how to avoid common beginner mistakes. An index is a list that represents a section of the market. The S&P 500, for example, tracks around 500 large U.S. companies. A total U.S. stock market index tracks thousands of companies across different sizes. An international index tracks companies outside the United States. An index fund tries to follow one of those lists. Instead of a fund manager picking 30 favorite stocks, the fund owns many stocks based on the index rules. If you buy a broad U.S. index fund, you may own tiny slices of companies across technology, healthcare, finance, consumer goods, and more. That diversification is the main benefit. One company can have a terrible year, but it does not control the whole fund. You are betting more on the market category than on one CEO. Index funds are often popular because they tend to have low expense ratios. The expense ratio is the yearly cost of running the fund, shown as a percentage. A fund with a 0.05% expense ratio costs about 50 cents per year for every $1,000 invested. A fund charging 1% costs about $10 per year for every $1,000. That difference sounds tiny until decades pass. If you invest $300 a month for 35 years and earn 7% before fees, a 1% extra cost can reduce the final result by a large amount. You do not need to obsess over every decimal, but you should know what you are paying. Lower costs do not guarantee better results every year, but high fees create a hurdle your investments must overcome. Beginners usually see two main versions: index mutual funds and index ETFs. Both can track the same type of index. Mutual funds often trade once per day after the market closes. ETFs trade during the day like stocks. For a long-term beginner, either can work if the fund is broad, low cost, and fits the account. Some mutual funds require minimum investments, although many have low or no minimums now. ETFs can sometimes be bought one share at a time, and some platforms offer fractional shares. Do not get stuck thinking one format is automatically superior. The bigger questions are simpler. What index does it track? What does it cost? How diversified is it? And can you keep investing consistently without trying to time every market move? You need an investment account before you buy an index fund. Common choices include a workplace retirement plan like a 401(k), an IRA, a Roth IRA, or a regular taxable brokerage account. If your employer offers a 401(k) match, that can be valuable because it is extra money tied to your contributions. For example, if your employer matches 50% of the first 6% you contribute, that can be a meaningful boost. A Roth IRA may be useful for eligible investors who want after-tax contributions and qualified tax-free withdrawals later. A taxable brokerage account has fewer retirement rules, but does not have the same tax advantages. The account choice matters because taxes and access rules are different. The index fund is the investment. The account is where it lives. The beginner-friendly way to invest in index funds is usually automatic and boring. Pick an amount you can repeat, such as $50 per week, $200 per month, or 10% of each paycheck. Then choose a schedule and stick with it. This is called dollar cost averaging when you invest on a regular schedule regardless of market price. Sometimes you buy when prices are high. Sometimes you buy when prices are lower. Over time, the habit can reduce the pressure to guess the perfect moment. A simple portfolio might include a broad U.S. stock index fund, possibly an international stock index fund, and depending on age and risk tolerance, a bond index fund. The exact mix is personal, but the process should be understandable enough that you can stay with it. The biggest beginner mistake is panic selling when the market drops. A broad stock index can fall 10%, 20%, or more during rough periods. That is normal market risk, not proof that index funds are broken. Another mistake is chasing last year's best-performing fund. By the time something looks obvious, the easy gains may already be gone. A third mistake is owning too many funds that all hold the same companies, which creates fake diversification. Also, watch taxes in taxable accounts. Selling frequently can create taxable gains. Finally, do not invest money you need next month or next year for rent, tuition, or an emergency. Index funds are better for long-term goals where you can handle volatility and give the market time to recover. Here is the simple index fund plan. An index fund tracks a market list instead of trying to pick individual winners. Broad funds can give you diversification, lower costs, and a beginner-friendly way to participate in the market. Compare expense ratios. Understand whether you are buying a mutual fund or ETF. Choose the right account and automate contributions so you are not depending on perfect timing. The goal is not excitement. The goal is consistency, patience, and keeping more of the return by avoiding unnecessary fees and mistakes. Subscribe to Money Hacks USA for more plain English investing explainers. The free tools and resources in the description support the channel at no extra cost to you. In investing, what is comfortable is rarely profitable. Robert Arnott.